New Jersey is one of the few states that allow automatic tax increases on its residents. Those automatic hikes happen because our income tax brackets aren't tied to inflation. In other words, as wages increase with inflation and rates remain the same, income tax bills go up. It hits all married couples filing jointly, but is particularly detrimental to the working poor and middle class. To understand the impact of this unfair policy, we need to know how income tax brackets work. New Jersey's lowest brackets are very close together for people making $75,000 or less. When income tax brackets are very close together, pay raises push taxpayers into a higher bracket, even though they really aren't wealthier. This can be costly for people and their families who rely on every dollar they earn. For example, a $35,000 salary in 1996, adjusted for inflation, equates to almost $57,000 today. If rates had been adjusted for inflation, the top rate for taxpayers earning $57,000 would be only 1.75% rather than the 3.5% it is today. As you can tell, the top tax rate doubled over a decade while taxpayers didn't become any wealthier. That shows New Jersey's progressive brackets are actually reducing a person's income over time when you factor in the cost of inflation. As incomes rise and people are forced to pay a higher rate, paying bills becomes harder and taxes just keep going up. Tying taxes to inflation is a vital reform to make New Jersey less expensive. The federal government has recognized the fairness of inflation indexing since 1986. It's a policy liberal and conservative groups agree would help the working poor and middle class the most. Taxpayers have been waiting too long and need to be recognized as people, not a source of government revenue. It's time to enact tax fairness and protect New Jersey taxpayers.